All right, let's continue with our discussion. What are the problems with using WAC? So one important problem with using WAC is basically the problem that we're just talking about, not just like a few slides back when we said, okay, an increase in the future cash flows of a company might be associated with an increase in risk. Now, if you take WAC and just apply WAC for a certain company and then apply that same number to all projects in that company, that could be very dangerous because you're basically not taking into account the fact that some of the projects are going to have larger cash flows because they are riskier, and some are going to have smaller cash flows because they're less risky. And having a fixed criteria, a fixed level of a weighted average cost of capital to calculate the present value of all these projects is not going to be the correct way to go. Just to highlight this, let's look at this scatter plot here. In scatter plot here, I'm showing you expected return of different projects versus risk associated with the projects, which we can measure in beta, right? Now this should be reminiscent of what? Of security characteristic line, right? Where we have the return versus risk, beta. So it's basically the same idea. Now you can think of this in terms of overpriced versus underpriced assets. So the only thing that you need to do is to plot a CAPM here and then basically identify which projects are undervalued versus which are overvalued, and then make selections based on that, right? That's all about it. So, however, what application of a single value as your weighted average cost of capital means is that you're going to have this horizontal line that stands for a certain amount, right, as the weighted average cost of capital for this whole company that is considering all these projects. And you're going to say, okay, these are the projects that I want, and these are the projects that I don't want, right? But that's really wrong. That's really, really wrong. You shouldn't do that. So in essence, to understand why this is wrong, you can simply plot the associated um, uh, security characteristic line by taking the market price of risk and the risk-free rate. So these two you can actually find from historical data or from the available data out there, and just plug in this formula, and then just plug that capital as a pricing model. And then once you do that, you're going to realize that, oh, I've been incorrectly excluding this. Say this was bad because the cost of capital, the expected return was lower than cost of capital. And I was incorrectly including all these, right, in my investment decisions when I was solely reflecting on WAC, right? So the projects here are very risky, right? And that's why they are giving more cash flows. And this one is of low risk, right? And that's why it has a low expected return. So it's actually not a bad project. It's a good project. So the way you really want to think about capital, the budgeting is always to incorporate the risk associated with a project, not just the weighted average cost of capital, the whole company. That's wrong to do. Okay? So this is a very, very, very important picture, and everybody should understand what this means and how this is related to our arbitrage arguments that we had last time. Okay, let's move on and talk a little more about financial risk here. So financial risk is created by creation of debt. So when you have debt, there's going to be financial risk. So if there is an all equity firm, basically, there's zero financial risk. If a firm chooses its financial risk with a choice of capital structure, right? What going to really matters is the maturity and the obligations associated with the debt within the capital structure. All right. So in a perfect capital market, though, the financial leverage has no impact on weighted average cost of capital. So we've already established this. So WACC is independent of capital structure, in which case a project's value won't be affected by the way in which it's financed. So it really doesn't matter whether you finance it by debt only or equity only. However, when financial leverage is there, it's going to alter how the risk of the project is going to be borne by debt holders and shareholders. It's basically the risk sharing that is going to vary with financial structure. Okay, so when we say WACC is independent of financial structure, it has nothing to do with the risk that the parties claiming the assets of the firm is going to bear. So to see this, let's think about the following. As financial leverage increases, what's going to happen is that the risk borne by both debt holders and shareholders is going to increase. Okay, why? Shareholders are going to be exposed to the possibility of loss of their cash flow because of the big obligations to debt holders. And then also when leverage goes up, debt holders are basically facing higher and higher default risk. Do you agree? And then because of that, there's going to be this detrimental impact on the risk associated with the investments of both shareholders and debt holders when you have more and more leverage. Okay. Um, if you think about it, actually, you will realize that in the limit, debt holders become shareholders, right? What if a company is fully financed by debt? Well, what does that mean? Well, if you finance your whole company by debt, you cannot really promise anything beyond the existing cash flows, right? So you're promising all the cash flows that are expected to the debt holders, which means that debt holders are in effect the equity holders in the company. So to see this, I'm going to have these two plots here. So these are returns to equity holders and debt holders of a company, right? So this is what equity holders receive. This is what effectively debt holders receive, or we paid, the corporation pays debt holders. So the leverage is 0. We're down here. WACC is exactly equal to required of return on equity, and when debt is 100%, WACC is exactly equal to required rate of return or the cost of debt, if you like. But then what happens is that once you get here to debt equal to 100%, the return or the cost of debt is actually equal to the cost of equity when debt was actually equal to 0, right? That's exactly meaning that debt holders become equity holders when debt is equal to 100%. Okay, so here's a numerical example that I'm sure you can just look at it on your own, so I'm going to skip this. Now let's try to see how financial leverage and beta is going to be related. So is greater financial leverage going to increase market beta or decrease it? Okay, so what we're going to see is going to show us that the increased leverage is going to increase stock's beta, right? By stock beta, we're referring to what you see on the market when you estimate the association between the stock returns and the market risk premium, all right? However, the financial leverage does not affect the risk of the assets. Okay, so this is different. So we have an asset and an associated risk with it, okay, a particular project, and we have the stocks of a company. Stocks of a company will have risk because they covary with the market. So what we will show is that once you increase leverage, the association between the returns of the stock and the market risk premium is going to increase. So you will have a larger stock beta, but there is no impact on the beta for asset. Okay. So the takeaway is going to be that the financial leverage has no direct effect on WACC, but it does have an effect on required of return on equity. Okay, so let's consider a firm with J different assets. So the J different projects, each of these projects have their own beta. And then the whole company could be thought of as a weighted average of all these assets, right? Depending on what proportion of a company each of these investment opportunities is making up. So the beta as a result for all of the assets, which we call beta A, BA, right, the beta average, the beta of the aggregate, is going to be simply the weighted average of all these asset-specific betas. So you can think of beta A as the intrinsic risk associated with the assets of the company, or average intrinsic risk associated with the assets of the company. Okay? Now, using the CAPM, what we have is that WACC for this particular company is going to be given by this. Note that the non-diversifiable risk associated with investment in this company is the product of beta A and the market price of risk. Okay, so we can see that WACC is independent of the capital structure. We don't see any term associated with L leverage here, so there's no reason we worry about the capital structure impacting WACC. All right. Now, how does the financial leverage affect the stocks beta? So I want you guys to distinguish between the stocks of this company, and the actual assets of the company. That's a very big difference. Okay. So let's call beta on, assume that debt has some systematic risk and call that BD or beta D. Okay. And then beta with no subscript is going to denote the beta of the stock. So that being said, we can basically apply CAPM to both of these assets. So return on the debt is going to be risk-free rate plus beta on the debt times the market price of risk. Return on equity is going to be the risk-free rate plus beta on equity times the market price of risk. Okay, so keep these two equations, right? Now, what I'm going to do next is that I'm going to say, well, let's recall the weighted average cost of capital formula, right? I have these two. Now, if I plug these two relationships, right, or plug for RE and RD from these two relationships, in this formula, what I end up with is something quite interesting. So I plug RE and RD from the previous slide, right? And then for WACC, I'm going to plug this. Okay? So with a little algebra, you would be able to show that this equation obtains when you play around with the algebra a little bit. So I would encourage you to actually do it. So this is how the beta on assets of the firm is related to the beta of debt, beta of equity, leverage, and tax. All right, so this is actually quite interesting relationship. So a very weak assumption that we can make is that the beta on debt is equal to zero. There's kind of risk-free debt, right? Or you can say debt has no systematic relationship with the risk in the market. Now, if we plug this equal to zero, we basically are removing this term. And if we remove this term, we end up with this relationship here, right? Which means that beta of the stock is equal to what? Is equal to 1 minus TL times beta A over 1 minus L. Okay? Now, out of this, you can see how leverage is going to impact stock's beta, right? So, let's see. If leverage goes up, right? If leverage goes up, what's going to happen to the denominator here? Denominator is going to go down, right? Because leverage has gone up and has a negative sign, okay? In the numerator, though, you have a different story, kind of. The numerator, it still is going to go down, nonetheless, because tax rate is always less than 1. The amount by which it goes down is going to be less than the amount by which this thing goes down, right? As a result, an increase in leverage is going to increase the stock beta. And we've already argued that it has no impact on beta A. So beta A could be think of something fixed, but then beta is what's the moving target here. Okay? Let's see an example and then see how we can actually estimate WACC. So ESC is considering expanding its current operations, and you actually estimate the WACC to be used in the project. So outstanding stock is valued 16.8 million. The debt has a market value of 7.2 million. Beta for the stock of this company is 1.8, and its debt is risk-free. Okay. Now, marginal tax rate is 37%, risk-free is 5%, and the required return on the market portfolio is 13. So we have all the ingredients that we want. Okay. So let's see. So because debt is worth 7.2 million, it means that the leverage is going to be the ratio of debt over the sum of debt and equity, 0.3. The beta is 1.8, stocks beta, and then tax rate is 0.37. Okay, thus the beta of the assets for this company can be calculated with the formula that we just established, right? And then if you do that, you will end up with 1.4. The beta for assets is always less than a beta for equity. Okay, and that's a very important point. As soon as you have debt, all right, equity becomes riskier than the assets itself. Why? Because the firm is obligated to pay off um, uh, debt, and because of the interest payments, the cash flow going to equity holders is going to be riskier, and that presents itself in a larger beta compared to beta A. All right, now moving on, calculating WACC, you just simply plug numbers in the capital asset pricing model. Be careful, you're using beta A because you're calculating weighted average cost of capital, not cost of equity. All right, 16.36% is the cost of capital. So what if we want to calculate WACC for different businesses? Suppose that a firm wants to expand into a new line of business, right? And then you're interested in calculating weighted average cost of capital for something the firm has not done so far. Okay, what will you do? So if the new line of business is of different risk, it means that the existing weighted average cost of capital for this particular firm cannot be used. Excuse me, you got to do something. There must be a solution to this. And the solution is actually quite interesting. You're going to estimate beta A for other firms that have a similar line, and then use those estimates or average of those estimates to estimate the beta A for this particular firm, and then plug that into CAPM to get the weighted average cost of capital for this particular firm. Okay, that's actually quite interesting to do. So what you need to do is the following. You got to calculate the stock beta for different firms that run the same sort of business. Those firms could have different levels of leverage. So you're going to use different levels of leverage of those firms, and then go back to this formula here, write this one, this here. I'm sorry, my bad. This here to so let me actually get rid of that. Make sure you guys do not. So this formula beta A is going to convert stocks beta from those companies that run that particular business to um, asset betas for those companies. And once you do that, you just take an average of those beta A's and then use that as a beta A for your own company, and then plug it back again in CAPM to calculate a weighted average cost of capital for this particular expansion. All right. So unlike the financial leverage, operating leverage is going to increase asset risk. All right. So we just argued that um, um, financial leverage has no impact on beta A, but operating leverage is going to increase beta A, and therefore is going to increase weighted average cost of capital. All right. Like financial leverage, higher operating leverage as a result is going to lead to higher stock beta. Okay, so this is important. So think about the channels. So the reason why operating leverage increases stock beta is because it increases asset beta. The reason why financial leverage increases stock beta, it's because it impacts the risk associated with cash flows of stock lists. They are different channels, but they have similar impacts on stock beta. All right, that's very important. So as mentioned before, given the available sets of technology, it's you have a very limited set of available possibilities for operating leverage, and as a result, WAC cannot have many different outcomes depending on the type of operating leverage. So that's a good thing. So it's less hard to deal with. Okay, let's summarize chapter 8. We have this cost of capital, which is the required rate of return on capital budgeting project. It's the opportunity cost of the funds used in the project, so it has a market implication into it. That's why we can use CAPM. It is not the historical cost of fund. It's not an accounting concept. It's going to reflect the risk of the project, which is not necessarily the firm's current operations, right? It could be something that the firm has in mind to do in the future. And what is really important is that each project is going to have its own unique cost of capital, and you would have to calculate it properly. All right, so this is all for chapter 8, and I will see you guys next week.